Why the 50-year mortgage is not the solution, and why housing has become so unaffordable. Intro: setting the stage. Housing. Something that should be simple, something that should provide security. A place to call your own. For generations, owning a home was part of the American dream. It represented stability, opportunity, and a foundation for building wealth. But today, for millions of people, that dream feels distant. Home prices keep climbing, rent is skyrocketing, and wages often fail to keep pace. In response, one idea has gained attention: the 50-year mortgage. At first glance, it seems like a solution. Stretch the loan over 50 years, lower your monthly payments, make homeownership affordable. But here's the truth: the 50-year mortgage does not fix the real problems. It only masks them. In this video, we're going to break down why a 50-year mortgage is not the answer, why housing has become so unaffordable, and what solutions could actually work. By the end, you'll understand why temporary fixes won't solve a decades-long crisis. Part 1. Why the 50-year mortgage fails. The idea sounds simple: stretch the loan, lower payments, make homes more attainable. But the reality is much more complicated. 1.1. Interest costs explode. A 50-year mortgage stretches your payments, but it also stretches the interest you pay. On a $500,000 home at 4% interest, a 30-year mortgage costs about $360,000 in interest. A 50-year mortgage? That can exceed $600,000 in interest. This means you could end up paying more than the house itself in the long run. Lower monthly payments don't make the home cheaper. They make it more expensive over time. And for families already struggling with student loans or credit card debt, this is a heavy burden that lasts decades. 1.2. Home prices could increase. Making it easier for people to afford monthly payments may drive up home prices. If more buyers can qualify, demand increases. Higher demand pushes sellers to raise prices, which means homes become even less affordable for those just entering the market. It's a cycle. Lower payments, more buyers, higher prices, more reliance on extended loans. In other words, the 50-year mortgage may make homes temporarily affordable for some, but it risks making the overall housing market even more expensive in the long term. 1.3. Debt commitment for life. Imagine buying a home at age 30 with a 50-year mortgage. You would not finish paying it off until age 80. This means managing payments through job changes, economic recessions, health crises, retirement. With today's uncertain economy and rising gig work, a 50-year mortgage can feel more like financial imprisonment than stability. It creates decades-long risk for families who cannot predict the future. 1.4. Generational impact. Homeownership has historically been a path to generational wealth. Parents pay off a home, equity builds, and children inherit an asset, not debt. With a 50-year mortgage, families might never fully own their homes during their lifetime. Instead of passing on security, they may pass on debt. This keeps younger generations financially stuck, making it even harder to build wealth, save for retirement, or secure their future. 1.5. Social and psychological impact. Long-term debt also takes a psychological toll. Stress and anxiety increase. Risk of financial burnout rises. People postpone other life goals, like family planning or education. A home should provide security, not perpetual financial stress. Part 2. The real causes of housing unaffordability. If the 50-year mortgage isn't the real problem, then what is? Housing prices are high for several systemic reasons. 2.1. Supply doesn't meet demand. Many cities, especially urban centers, simply don't have enough housing. Zoning restrictions, long approval processes, and political resistance prevent construction. Developers focus on luxury housing because it yields the highest profit. Affordable housing is neglected. The result? A shortage of homes for the average person. Rising prices. Rents that keep climbing. 2.2. Real estate as an investment. Homes used to be primarily shelter. Now they are financial assets. Investment firms and wealthy buyers purchase multiple homes to rent or flip. They don't live in them. They don't build communities. Speculation pushes prices even higher. Every home becomes a profit opportunity, not a safe place to live. 2.3. Wage stagnation versus rising costs. While housing costs have surged, wages have mostly remained flat. This disconnect means many people cannot save for a down payment. Mortgage approval is harder. Rent consumes a larger share of income. It's not personal failure, it's a structural imbalance. 2.4. Low interest rates fueled demand. Low interest rates in recent decades made borrowing cheaper. This increased demand, but it didn't increase supply, so prices rose instead. Cheap borrowing temporarily helped some buyers, but the long-term effect was higher costs across the board. 2.5. Urbanization and gentrification. More people move to cities for jobs, education, and opportunities. Limited space plus high demand drives prices up. Gentrification often displaces long-term residents. Neighborhoods change, but affordability disappears. This creates thriving urban centers, but leaves working-class residents struggling to find stable housing. Part 3. The social and generational effects. Unaffordable housing affects more than finances. Young people delay marriage and family formation. They postpone home ownership and wealth accumulation. Social mobility decreases. Communities fracture as people move further from jobs and family. This crisis is not just about money. It's about life trajectory. It's about the ability to plan a future. Part 4. Potential solutions. A 50-year mortgage is a Band-Aid. True solutions require structural changes. 4.1. Increase housing supply. Relax restrictive zoning laws. Encourage developers to build affordable housing. Invest in public and community housing initiatives. More homes equals lower pressure, equals more attainable prices. 4.2. Prevent speculative investment. Homes should primarily be for living, not purely for profit. Policies can reduce bulk buying, corporate hoarding, and predatory practices. 4.3. Align wages with cost of living. Income growth must keep pace with housing costs. People shouldn't have to work multiple jobs just to afford a roof over their head. 4.4. Shift perspective on housing. Treat housing as a human need, not a commodity. When housing is secure, families thrive, communities stabilize, children can build futures. 4.5. Community-based innovation. Alternative housing solutions can help. Co-housing, shared ownership, micro-apartments, rent-to-own models. These solutions offer flexibility while building stability and equity over time. Conclusion. The 50-year mortgage may look like a solution, but it is only a temporary fix. It stretches debt over decades, increases interest costs, risks driving home prices higher. The real problem is systemic. Shortage of supply, wage stagnation, speculation and investment, gentrification and urbanization pressures. Solving housing affordability requires long-term structural changes. Everyone deserves a home. Everyone deserves stability. Housing should be a right, not a lifelong financial burden. It's time to stop patching the problem and start building real, lasting solutions.